When studying the revenue recognition rules, as we've stated, there's a 5-step approach, and we've used the little easy memory tool, I am a star. We've covered the identifying the contract and the separate performance obligations. The third one is a challenging one. It's the transaction price. What do you expect to be entitled to? And there's a lot of variables that go into that. What does the contract say? What are your standard practices? Do you always give a little bit of a discount? Or what happens if there's a range of prices? And what happens if there's variable consideration? What about the time value of money? Non-cash consideration. All of those factors have to be weighed into the decision-making process. Variable consideration can be such things as licensings and royalties. It could be a bonus for finishing the job early. It could be a penalty for finishing the job late. Those are fundamental items that have to be anticipated. The time value of money. If, after performing the service or delivering the good, payment is stretched out beyond 1 year, we have to factor in the time value and discount it back. Non-cash consideration is also an important item. You may have a situation where you're going to provide goods to a particular customer, and in return, they're going to give you money, but they're also going to give you, say, a piece of land, or they're going to give you stock of their company. And an ASU came out, an ASU 2016-10, that specifically identified when do you fair value that item? And the answer is you fair value it on the contract date. So the determination of the non-cash consideration is done then. Of course, then the question comes up, well, we signed the contract on January 1, but the delivery of the goods is until July, and we don't get paid and we don't receive that land or that stock until July. Obviously, the price and the value could change between now and then. What do you do with that? Well, then you handle it under other GAAP. So an example, if it was land that you received, you fair valued it on January 1, the date you signed the contract. And then if it changes value by July, then what happens is you're going to look at it. If it's gone down, it's potentially impaired. If it goes up, we of course don't write up land under US GAAP. If it was stock and it went up or down, we do test it. And of course we handle that typically under ASC 321. So those are the fundamentals of handling the transaction price as we go along. Now, as we mentioned, there's another issue. What happens if it happens to be intellectual property? If it is, we have to determine if it's functional, such as software, media content, or drug formulas, or if it's symbolic, like a trade name. Some of you have seen this one, the official car of the New York Yankees. Well, obviously, the car manufacturer paid the New York Yankees so that they could make that statement. Typically, if it's functional, we ask ourselves, is there any other requirements other than just giving them access to our information, such as you're going to buy Microsoft Windows? Then it's point-in-time revenue recognition. So we're going to take a look at some of those a little bit later. If it's symbolic, which means you have an obligation to keep your name, say the New York Yankees or any other sports team up, well, then it's going to be recognizing revenue over time. So there's a lot of details, and they can be found in Accounting Standards Update 16-10.